Here's an explanation to one of the ICT methods, which called swing points. To understand the concept of swing points, we need some candles. Here we go. In the swing high, the center candle has a lower high to the left and a lower high to the right. In a swing low, the candle in the center has a higher low to the left and a higher low to the right. Many retail traders stop orders just above swing highs or just below swing lows, meaning that liquidity is deeper in these areas. Recall that in a long trade, the stop loss and a take profit targets are sell orders, and in a short trade, the stop loss and take profit targets are buy orders. This idea leads us directly to the concept of buy-side and sell-side liquidity. Just above the swing high, there are a lot of stop orders, and there are also a lot of buy stop orders for long-term traders when the price surpasses the swing high. In ICT terms, this level shows buy-side liquidity. Just below a swing low, there are a lot of stop-loss orders from long trades, which are sell-stop orders, and there are also a lot of sell-stop orders from traders who want to go short if price surpasses the swing low. In ICT terms, this represents sell-side liquidity. The identification of buy-side and sell-side liquidity level is important in many ways in the ICT method. Now concentrate on the following video that explains swing points by a trading expert.
In this 5-minute chart of the mini S&P, we currently have a low. This is a potential swing low because the candle to the left has a higher low. If the next candle produces a higher low, the current candle will be classified as a swing low, which represents a point of sell-side liquidity. Moving forward one candle, we can see a higher low, so we can go ahead and classify this low as a swing low. While we were paying attention to the swing low, notice that we also have the potential for a swing high in this candle. That's because the candle to the left has a lower high. If the next candle also produces a lower high, this point will be classified as a swing high or buy-side liquidity. Moving one candle to the future, we can see that this is exactly what happens, so we can go ahead and mark this as a swing high. Right now we also have the potential to another swing low. If the next candle produces a higher low, we'll have another swing low at this point. Going forward one candle, we can see that it doesn't happen. The new candle forms a lower low. Now this new candle is a potential candidate for a swing low because it has a higher low to its left. In the next candle, we can see that a new swing low forms, so we can go ahead and mark it out. In the next two candles, we can see that price takes out the last swing high and comes back to test it on the other side as support. Over the next four candles, we can see that only higher highs and higher lows are formed. Eventually, price produces a candle with a lower high and renders the previous high as a swing high or buy-side liquidity, so we can go ahead and mark it out. In the next candle, price continues to the downside. Identifying swing points is very simple, but it's a good idea to practice it in replay mode or real time so it becomes second nature to you. Once we start to mark swing points in real price charts, it becomes clear that certain swing points cluster together while others remain isolated, giving rise to two distinct definitions of highs and lows called.
Subscribe to Aristophane to enter the world of finance.